Paul Rosenblum is a bookkeeper, not an accountant or a CPA. Although the information in this podcast comes from professionals, it's meant to give you enough knowledge about these subjects to have a meaningful dialogue with your tax preparer about bookkeeping and taxes.
It's February 1st when I'm writing this, and I have survived another January of 1099s. I must admit that I forgot one 1099 for one company and another very small company that consisted of another one or two 1099s. They will be done within 24 hours after the deadline, and there won't be any penalties. It'll be nice to go to the office on Monday, February 3rd, and go back to bookkeeping and not think about 1099s until next year. Welcome to February, although this episode will be live at the end of the month. The last episode, I talked about ethical issues for bookkeepers as well as pricing, and this episode, I will continue talking about ethical issues involving tax preparers first and then client situations. First, the word fiduciary. The definition, according to dictionary.com, is of or relating to the relationship between trust and good faith between a fiduciary and the person for whom the fiduciary acts. The executor of a will has a fiduciary duty to act in the best interest of the beneficiary. The banks do not assume any financial responsibility. They act in a fiduciary capacity only. The American Medical Association says that physicians have a fiduciary responsibility to patients. I'm Paul Rosenblum. There is nothing that I can find that says that CPAs or accountants or EAs, enrolled agents, and bookkeepers for that matter, have a fiduciary arrangement with clients even with an engagement letter. However, sometimes fiduciary and ethics commingle in the same headspace. Let's take a recent example during 1099 season, which is January of every year. There was a client who I had a big blow-up with last October and walked away from. Yes, I too have emotions that show once in a while. And even though they always paid me, they did not pay their tax preparer for the previous year's taxes. And now it's January of 2025, and the taxes for 2023 weren't paid yet, at least according to the tax preparer. I asked why the tax preparer was creating 1099s for that client without getting paid, and he said because he had a fiduciary agreement and had to, as long as they were a client. Either he doesn't understand fiduciary and doesn't understand that tax preparers aren't included as financial advisors are, hence he doesn't have a fiduciary agreement with clients, or he's just hiding behind it. This is where ethics comes into the space. Even as CPAs, accountants, and EAs, enrolled agents, we all run businesses with the same rules as everyone else. We all have accounts receivable, money that is owed to us. We all have some collection difficulties, and most accounting firms write off some fees that will never get paid to them after dropping a client. Usually, it's the bottom 10% revenue clients are dropped after tax season, or a problem payer. If a tax preparer or a bookkeeper keeps a client who doesn't pay, the reason would be to keep the relationship open and hope that you will eventually get paid without suing that person or company, which most tax preparers don't want to do because of Yelp reviews and other places that ex-clients can post their bad reviews on. So we let them ride. I've done that, and most of the time I end up getting paid. Besides, since I am in their books, I know how much money they have in the bank. But a tax preparer usually doesn't have access to their bank account, So they have a different situation. So the question is, how long does a tax preparer wait until he or she stops working for the client who doesn't pay? How does a tax preparer handle their own accounts receivable? And when is one willing just to eat what's owed to you and call it a day and move on? I've had a few small clients not pay me in 2024, and I just walked away 6 months later after sending them an invoice every month and getting no response. By the way, I just saw on the news that Costco employees will get $30 an hour to work in the stores. I'm not charging enough for sure, but that's for another day. There's a CPA who I do work for, and the client who we share owes more money than they are ever going to be able to pay. The CPA suggested to the owner of the company to sell the company and in the agreement stay on as an employee for a few years. That was immediately rejected. The CPA suggested that the owner declare bankruptcy so much of the debt will go away. That was rejected as well. This is good advice for what the situation is, but it still doesn't fall in the fiduciary arena. It's a CPA giving a suggestion to a client to accept or reject. How much unsolicited or even solicited advice should a tax preparer or a bookkeeper give a client? That's probably for another episode, but let me say that if I give advice to a client, I always preface it by saying that I am not a certified financial advisor, and this is my opinion based on almost 30 years of working with businesses and doing a lot of research and having a podcast, so it's my educated opinion on these matters. Take it or leave it. Fiduciary and ethics intermingles like a unisex bathroom. Did I really just say that? There are also situations where ethics and the letter of the law inhabit the same space. These are tougher decisions on how to handle the situation. I had a situation relatively recently where a client who was using QuickBooks Online payroll added a tip line. Tips are part of payroll and should end up on the W-2 form at the end of the year as taxable income for the employee. The tip is collected on the customer invoice and then gets paid out when payroll is processed. For some reason, however, there was a very small amount of tips collected in 2023, and that tax return was already filed, sitting on the balance sheet in a liability called tips payable. In 2024, there was even a smaller number of tips payable, sitting as unpaid to employees. In 2024, there were employees who the company had to terminate due to illegal behavior back in 2023. The agreement to keep these people out of getting arrested is that they didn't fight for unemployment and would have no contact with the company again. More than a year later, this honest mistake was found. The question is this: what to do about it now? The first thing that I asked the client is, why didn't the tax preparer see this on the balance sheet in 2023 when they prepared the tax return? Since the company is a single-member LLC, the tax filings do not include a balance sheet like they do in a partnership LLC or an S corporation. The client only sent the profit and loss report to the tax preparer and not let them, or even consider letting them, log into their books to run their own reports. If you are going to use QBO, the online edition of QuickBooks, then should you just let the tax preparer see the books? Not necessarily to make entries, but to go through everything to make sure the books are accurate. client rules and client ethics. Yes, rules for the client, aside from paying the tax preparer for tax returns. The 2023 tax return is done. To amend a tax return for just a few $100 would be a flag for the IRS. Not worth that, as well as paying maybe $1,000 to a tax preparer to amend a tax return that only changes by $300. Next suggestion, pay the people the tips from 2023 in 2025. Send a check in the mail explaining to them it's an honest mistake and that it's just now being caught. However, that could open up a large can of worms that no one really wants to open. The ex-employees could come back and say that they had other tips that were not paid and could report to the appropriate authorities and cause audits and problems for the company, and the saga continues, all for $300 to $400. Sometimes in situations like this, one has to think what I call outside the box. Is it technically illegal not to pay tips to someone? Of course it is. If you get caught, could you pay thousands of dollars penalties for a $300 tip? Sure, you could. And this is my opinion only. If I dropped every client who was doing anything not to the letter of the law, either on purpose or by accident, I wouldn't have any clients left. I'm in New York City, so sometimes reality bites. In this case, it was an honest mistake, but correcting it could make life chaotic and terrible for the business owner, all over $300. So what does one do? The client told me all of this with other details not mentioned here and asked for my advice. I gave her some ideas. The most sensible one was to take the tips in 2023 that was sitting in the tips payable account and debit the liability to zero out that account and credit sales in 2025. This way, in 2025, the company would at least pay income taxes on the amount in question, and the 2024 tip payable could be split to the remaining employees. In 2024, payroll taxes wouldn't be paid, but would be paid in 2025. I don't know how this will end, and I hoped that the original employees who are no longer with the company could get this money, but that's not really an option based on this particular situation. Sometimes you just have to do the lesser of all evils. When the company calls QuickBooks Payroll and finds out how to correct this from happening again, it's important, I told the owner, to get a name of the person who they talked to at Intuit and keep the email with the case number that can be referred back to if needed. Also, it's important to document that the tax preparer only got the profit and loss and not the balance sheet, so this mistake was never even seen by them. And document that the problem is fixed moving forward. The beginning of that mentality started in 1994 when Intuit started a huge ad campaign saying how easy QuickBooks was to set up and use. People believed it until some didn't and came to their senses and hired a real bookkeeper, not their administrative assistant or front desk person who had time on their hands. I had a situation in 2020 where the company had a cash payroll of around $80,000 for the year of 2019. I was having trouble balancing the point of sale to the cash on hand account, and yes, I can do an entire episode of how those two numbers work together along with sales tax. But I was off by around $75,000. When the owner figured it out, it ended up being the cash payroll paid out from the cash sales that went into revenue and the cash on hand account, but not taken out of the cash on hand account because I didn't know about it. Not only did I raise my dissatisfaction of a cash payroll, we also had a conversation about how to account for it the best way we could. I suggested to take the $80,000 and evenly distribute to both owners in guaranteed payments, which show up on the P&L, and make it taxable income on their K-1s so that at least they would pay the tax. We got on the phone with their CPA and told them what was going on. My suggestion was explained, and the accountant agreed that that would be one way of fixing it. The IRS and the state don't really care where the tax comes from, just that the taxes are paid. The owner said that they didn't want to pay tax on it, period. The CPA said okay, and right after that phone call was over and taxes were filed, I fired the client in an email explaining to them exactly why. That was intent. Doesn't pass the ethics test in my world. So case by case, one has to decide what to do and what's right in their vernacular. This puts the CPA in a tough position. They are signing a tax return saying that there's no fraud that they know of, but that wasn't true. If ever questioned about this, the CPA would either have to lie or even possibly lose their license if they tell the truth. That's a tough position to be in. That's it for now, taking the rest of February 1st off except for writing this episode. Tomorrow is a new week and a new month, new deadlines, new clients, new ethical situations, and less sleep and bad moods. Just ask my wife. Be looking for our live webinar sometime in March. Still working out what software to use. Email me your questions and anything else that you'd like me to talk about there to bookkeepermensch@gmail.com. Be in your earbuds soon. Your friendly neighborhood bookkeeper, Paul Rosenblum.